Next up, we'll hear from Nikolaj Nyholm. He's a serial entrepreneur and an investor. He's founded 4 pioneering technology startups and is now a partner at Sunstone Capital. Please give a warm welcome to Nikolaj.
Great, so good afternoon. When Mikko asked me to come over and have a little bit of a chat here, he asked me if I could sort of give the perspective of being the entrepreneur who goes to the VC side, and what were some of the things which I as an entrepreneur really felt agitated about when dealing with VCs, and how does it then really look on the other side? Is there stuff we can still fix? How we actually come? And so just to give you a little, just very short perspective here in these 10, 15 minutes. My first startup was back in 98, 99. It was a company called Speed Names. We did domain search and registration. I never finished college, but I actually used my college, my student grants, my student loans to fund this. We pretty quickly grew it to 20 million euro business, flattened out after .com, and ended selling it to a British listed competitor. This was actually also the only company where I really knew what I was doing by the time when I jumped into it. I really knew the domain, I knew the problem, and I'll get a little bit into that at a later point. The second thing, organic network, I actually co-founded it with another speaker who's here tomorrow, Thomas Madsen Mugdal. We're trying to build a social Wi-Fi router to make it easy to share. The company closed down, but parts of it still lived along with an open source project called OpenWRT. I then spent a year with this guy, probably my biggest inspiration in my years in technology, Tim O'Reilly, being the European tech evangelist for O'Reilly, doing a couple of conferences. And that very quickly got me going with the next startups. The first one was a mobile social network back in late 2005, early 2006. So we were trying to do stuff which, without a smartphone and without GPS on the phone, Symbian 3, Symbian 2, J2ME, good old Nokia phones, but horrible thing to execute. Well, we ended up merging it with another Danish company and then selling that to Vodafone. And then finally, my last startup, Polar Rose, computer vision, so face recognition, image recognition, and we sold that to Apple in 2010. And at that point, I decided that it was sort of time to get out of the operational role. So I joined Sunstone. We're an early stage VC, meaning we typically get in at the seed or the A level. We invest in Northern and Central Europe, so basically a triangle between Stockholm and Helsinki in the north. Here in Helsinki, we have a portfolio company called Microtask. Budapest in the southeast with Prezi. And then a couple investments in London. Everything is really happening within that triangle. The latest fund is 86 million euros from 2011, and we've mostly been doing investments in Sweden and in Germany with that since then. So I think my investment, I don't know, say philosophy or practice is in Sunstone is very much modeled what I was doing in real life before that. I try to solve hopefully really big problems. I do think I have the issue of getting in a little bit too early on the product cycle. And when joining in 2010, there were tons of things coming in there which one wanted not to replicate. And I think that some things are very obvious, and they're easy to bash on us as VCs for, and some are more subtle. And to start with the obvious ones. Many VCs are still extremely short-sighted. One aspect of this is of course, VC funds who make a business out of diluting their founders until the time where they basically have taken over the company and can sell it at a much lower rate. I think that type of principle is one which doesn't hold very long. It doesn't hold a whole lot of fund generations. And those VCs are starting to get out of business. They were very often run by the finance-driven VCs who were the first generation of VCs who came on board here in Europe. I think the other one, which is a little bit more serious, is the fact that there are structural elements of the VC model which are slightly broken. So a typical VC fund receives a management fee of somewhere in the realms of 2% per year for the capital that they have under management, and then they receive a carry. And the carry is a profit sharing under above a certain level. So after you've returned the fund plus an annual carry of 9 to 10%, then you do a 20-25% profit sharing with your investors. And I think the issue that happens here is that certain VC funds, they find out that they're never going to get into carry, and instead they start milking the management fees. So instead of closing down or selling back to the entrepreneurs, or even selling the company to somebody who really wants to buy it, the moment that happens, a VC loses their management fee. And I have to say, I've really seen many examples, unfortunately, of VCs. There's definitely an example in Denmark, and I could also name an example here in Finland, of funds who end up milking the management fee rather than doing what's right for their investors or even for the entrepreneurs. So, fortunately, there's this thing called transparency, which has been, getting at us the past couple of years, and I think that is really what ends up. I'm super impressed with what's happening from the funded, angel list, but even initiatives like Startup Sauna or Seed Camp of bringing the entrepreneurs up to speed with the VCs. And I think this is definitely a healthy situation for Europe. You're not in a good negotiating position if you come in and the VC has proprietary knowledge to you. So the more we can share from the VCs to the entrepreneurs, from the entrepreneurs to the entrepreneurs, the better a position the entire ecosystem is in. And the less do we have these ridiculous term sheets which were floating around just 3, 4, 5 years ago until initiatives like the Seed Camp and the Funded's basic term sheets. So when we get to some of the more subtle stuff, I think this one is really, really important. You're going to have VCs who say they never invest in first-time entrepreneurs, and some of these VCs will also say, that we can fix the team. Everything else might be right, but the team needs a little bit of fixing. And most of you probably know of Mark Andreessen's product market fit. And I think that's very, very important also to address in the entire life cycle of a founder, a CEO, a managing team. I really think that the nuance that we do need is that we need to split the product market fit into a product fit and then a market fit. And those two cycles are very, very distinct. And I think having a thesis or even just having an idea from the VC side that you can go in and fix things through the team in the early product fit cycle is very, very difficult, if not to say impossible to do. I mean, you do find VCs who have an amazing product knowledge and who can really help drive the product. You have Fred Destin at Atlas. You have my partner Christian Jepsen at Sunstone. You have David Gardner, who spoke here this morning. London Venture Partners. Very obviously in the specific domain of games, but these guys can really help you drive these. They can really help you drive your product, but they can't go and bring somebody from the outside who doesn't have the domain knowledge, who doesn't have the product knowledge, who doesn't understand the problems being attacked with a product and then hope that's going to fix it. On the other side, once you've reached product fit, either bringing somebody there to be on the side of the entrepreneur or potentially even replacing the entrepreneur as CEO, and then the entrepreneur goes and works on the product. That's what I did at my first startup. Once we reached the 10-15 million euro run rate, that's when it was time to bring in somebody who could maximize it on the market cycle. And that's that's expanding the sales team. If you're an enterprise team, it's probably marketing if you're more a consumer type play. So I think this is, for me, this is one of the small, subtle things which a whole lot of VCs don't realize or recognize. And of course, there's not a 100% truth or 100% wrongful thing to do here, but it's one of these subtle nuances which I think is going to become more and more important over the next couple of years in Europe. The other part which entrepreneurs typically don't understand when they start engaging with a VC is, or that they tend to forget, is that we're running a business too. And the fact that when you have received an investment from an Excel or an Index or an Early Bird or a Sunstone, that you don't have entitlement to the next investment. I think the early financial VC, or financially, I wouldn't say financially driven, but the early VCs who had a more sort of like financial background, they took in de-risk by splitting an 86 million euro fund into 20 investments of 4.2 million euros each. That was the way that they de-risked. But I think that what is happening and what is working is that you lean into the good investments and you lean out of the bad ones. And when we've been talking about the past decade that starting up a business has become cheaper and cheaper, it's definitely true. But building a great business, building a business like Spotify or building a business like Rovio here in Finland still requires tons and tons and tons of money. So for the VCs, the good news is that the cost of failure essentially is very low. We should know pretty early in the process if it's time to step off an investment and not be trying to maximize our returns on something which might only return a couple of million euros to us. When we raise when we go fundraising, the promise that we tell our investors, our limited partners as they're called, our LPs, is that we're going to return their money threefold back. And for an 86 million euro fund, that's it's a 250 million. 250 something 50 million odd euros. So it's going to be the big returns that matter. And I think that's also important when you're dealing with the VCs, that you might bring them a 20x back, but if that's on a 200,000 euro investment, that's going to return the 4 million euros, which is only going to make, even for a small fund like Sunstone, is going to make a dent in the pot of money that we need to return to our investors. The other aspect, and this is something I was acutely aware of, but never really acted according to when I was on the entrepreneurial side, is really the vintage, the life cycle of a VC firm. So we typically go in, we raise a 10-year fund, and in the first 5 years we can do active investments in that. And in the subsequent 5 years, we can only do follow-up investments, or more correctly, this is the time when we need to exit our investments. So if you're an early stage company and you come in year 4, year 5 of a VC fund's lifetime, then you're very, very quickly going to, the fund is very quickly going to look at how can they get rid of you again. And that's definitely not a winning proposal for an early stage company, which might still just be finding its balance with regards to product. So I'm just going to end off with one little quote, and this of course comes from Tim O'Reilly also. Of creating more value than you capture. And I think that's something that we as VCs have to recognize, but it's definitely something that you as entrepreneurs can recognize and realize also. And that is the entire, I would say, ecosystem of what you build around your company. I think it's, it's the MySQL with all the developers. But it's all the way down to to an event like this, like Slush, where we're really capturing Slush or Startup Sauna is capturing such a small portion to what's being created altogether. And I really want to recognize Mikko and all the other guys who've been working hard here to do that. So if you live by that principle, I think you're at least moving in the right direction and hopefully onto success. Thank you.